Hello, everyone, and welcome to another Wall Street from Main Street podcast. Today, we have a special guest. He is actually also my former boss from Asset Strategies International, bullion, precious metals, and foreign currency dealer. This company is Porter Stansberry's number one referred company. Porter actually stated himself this is the only place he buys from. They were also featured in Wayne Allen Root's book, The Ultimate Obama Survival Guide, and actually wrote Chapter 18 on precious metals in that book. And they are also heavily endorsed by Oxford Club and Agora Financial, and were co-founders of the Perthman Certificate Program. Rich, this is the Vice President. Welcome to our show.
Great to be here. Thanks for having me, John.
All right. Well, the first thing I wanted to get into was when I first started working for you was the philosophy of core holdings, which is something I didn't hear about in precious metals. Can you elaborate on that?
Yeah, absolutely. As you mentioned, we deal with precious metals, foreign currencies primarily of late, and I think we might talk about this a little bit later. We're branching out into rare tangible assets, which we think is an exciting category in this space and in this current economic climate. But for 31 years now, our philosophy is very simple. We feel like we can bring wealth protection or asset protection to a portfolio through what we call a three-legged stool. And that is helping clients diversify their assets globally using the metals and currency markets, because we think true protection comes when you don't have all your assets in any one currency, in any one country, or in any one asset class or investment. And we take that a step further. When we use precious metals, we look at, what happens with mismanaged fiat currencies. I think we might get into that a little bit as well. And we compare that to the intrinsically valuable characteristics of gold and what it's done for purchasing power over 5 millennia. And we feel that gold, first and foremost, is a form of wealth insurance. So that's the core holdings of your portfolio. It's a small percentage, maybe 5-10% of net worth, typically is what most advisors would suggest. And basically it's a store of value, store of purchasing power in a liquid form for a potential financial crisis that you hope you never have. And our thought is to buy it and hold it and maintain that allocation. If you have an emergency, immediately sell that liquid store of value to meet the financial obligation, and then over time, as the situation passes, rebuild your position. If you're fortunate enough never to have such a financial crisis in your lifetime, first off, wonderful for you. Second off, use those assets to give your heirs a start in life.
All right. And one other thing, the late Glenn O'Keefe talked about is when you're first starting out, he always had the importance of making sure the bullion's liquid, not being assayed.
Yeah, that's a good point. And there's a few ways to do that. Typically, if you deal with small bars, kilo, which is 32.151 troy ounces, or less, 10-ounce bars, 1-ounce bars. If you deal with primarily 1-ounce coins from major mints like the U.S. Eagle or Buffalo, the Canadian Maple Leaf, the Austrian Philharmonic, the South African Krugerrand, or the Australian Kangaroo in gold. If you're dealing in these forms, typically there's virtually no counterfeiting or shenanigans going on with that type of material. It's all readily liquid and recognized worldwide. So if you do have an emergency, you can go ahead and exchange that anywhere. I mean, you can take it to a pawn shop, a jeweler. You could do private sale, or where you'll get your best value is typically through a precious metals dealer. So, emergency money or insurance is only good if it's there when you need it. So we suggest typically that their first purchases of precious metals would be things they would take delivery of themselves in a very, very liquid form, and that's to meet the obligation that comes up today. If your allocation is larger, due to higher net worth, it's typically just a percentage, then what you do is you start spreading it around to different programs, different forms, in different jurisdictions to get that protection from the three-legged stool. but the first place you start owning gold is right at home and close at hand. So if you have that emergency, you can beat it.
Yep, that is the first thing I learned. So, and the second thing is what I want to get into now is the government shutdown. Lately, as typical, at the last minute, they decided to raise the debt ceiling. What is your thoughts on the implications and the long-term trajectory of this?
I think you know my views, but to share it with your listeners, I think this addiction to credit is like an addiction to crack. The bottom line is you can't tell me that raising the debt ceiling has no impact on how much you're going to spend or how responsible you're going to be as stewards of your and my money. Okay? It is an indicator, absolutely, that we have no fiscal constraint, no fiscal responsibility, and this trend is clearly established. I challenge any of your readers to search the internet, pull up a chart of the value of gold priced in dollars for the past 100 years. And if you look at that chart, it is an eye-opening example of where the wheels fell off this cart. Basically, we had no increase in the value of gold, or very, very slight increase in the value of gold up until the early 70s. And John, I know you know what happened there. Nixon closed the gold window and basically made it so gold and dollars were no longer freely convertible or backed. And in essence, that means the government no longer had to balance its checkbook like you and I must do every day, every week, every month. So they were opening the door for themselves to spend much more than we ever took in, and it's a luxury or a curse, depending how you look at it. If you're a politician, it's a luxury. If you're a citizen seeing your dollars devalued over time, it's a curse since the early 70s. So we don't balance our checkbook. We spend on whatever is going to get us votes and keep us in power, and we put aside what's important for the long term in this country, which is responsibility and accountability. And I think it's a bad sign every time we even talk about raising the debt ceiling. I don't think it should ever be on the table. I think we need to cut and live within our means as a country. And if we make promises we can't deliver, we should restructure like businesses do when they go defunct.
Yeah, and not only that, I think this raising of the debt ceiling, combined with Janet Yellen as the new Fed, should completely take any idea of tapering off the table.
There's no other way to pay for it.
Oh, yeah, so there's definitely, and I think one of the reasons they talk about tapering is they don't want to fess up that, the government can't pay for this debt without money printing.
Well, it's long been the politically expedient alternative. Basically, if you default, that's catastrophic, and it has global implications because we're the engine that drives the world economy still, even with our dysfunction. But if you print more money, devalue the dollar over time, make it worth less, then everybody's dollar in everybody's pocket goes down a little bit over time. It's insidious, but it's politically palatable, publicly accepted. And I think if everybody knew what was going on, they'd react. But it just kind of seamlessly happens in the background that every dollar's worth less, and all the more reason to own intrinsically valuable assets, things that are priced or measured in U.S. dollars, because they hold their value. And the dollar loses the value through fiscal mismanagement, and in the future it should command more dollars when you go to trade it in.
Yeah, and transitioning to one thing is, despite with all this happening, how does the precious metals, how does the physical market look right now?
It's kind of interesting, for the past couple years, we really have a phenomenon where I think synonymous. Investors are like deer frozen in the headlights, and they don't have a clear direction. They're being told that we're in the midst of a recovery, and they want to believe it, but they don't. Back in September of 2012, in the Q&A session following the announcement of QE3, I think it was very telling what Ben Bernanke said. And I'm going to paraphrase because I don't have the quote in front of me, but you can look it up and tell me if I'm wrong. He said that the problem we have with our economy right now is consumers aren't spending, and therefore businesses aren't willing to expand, invest, et cetera. And he said, basically, if we can make people feel, and that's a quote, feel better about their situation because their 401k or their mortgage looks, that's a quote, better, not is, but looks better, then they would be more inclined to spend, and that spending would be the impetus to allow businesses to grow, invest, et cetera, and hire. So he was very clear to me, and I don't think I have to read too much into this, that all he wanted to do was inflate the value of the stock market, inflate the value of home prices, so people felt better about the situation. And by the way, that's working. Consumer confidence is at the highest levels it's been since 2005, before the crisis. So if everybody's feeling better, they're going to be inclined to spend. The only problem is the next step isn't happening. Nobody's spending. Instead, we're saving and paying down debt, which is, I think, the responsible thing to do. But Bernanke's not getting his punchline here. And as a result, everybody's kind of sitting on the sidelines, and it's not just with precious metals, it's with traditional investments for the most part. I think the values you're seeing in the stock market are very much attributable to QE as opposed to increased value in any particular corporation. And, you know, this is not something that a growth is sustained upon. Every time the government puts money in terms of printing and QE, we see an increase in the stock market. The moment they stop QE, the wheels fall off of that cart, and the market drops. They thought they did enough, but there's nothing there to sustain it. I think the growth is more smoke and mirrors than anything meaningful at this point.
Yep. And, well, I actually want to transition now into a subject that rare coins. Now, I have to admit, when I started working at ASI, I was completely against rare coins. I thought they were just garbage. But you, Steve, Carl, Michael actually did teach me the value of rare coins and how they do well. And now, once I get more money, I plan on adding them just for collectors and stuff to hold for a long time. And looking at the returns in Wayne Allen Root's books, he talks about in January 2013, a single rare coin sold for $10 million for the first time.
Yep.
Type 1 $20 Liberty dated to 1850 was bought for $12,650 in October 2001, and then sold for $31,000 and 50 cents. And looking at the rare coin index, over a year it's gone up from roughly 66,000 to almost 68,000. And since 1994, it's gone up, the rare coin index, 44%. Yet it has a pretty bad reputation. Can you explain why?
Yeah, and this is the impetus behind the launch of our new rare tangible assets strategy, which involves truly rare coins, high-end rare coins, and truly rare investment-grade stamps through Stanley Gibbons in the UK. I don't know if you're aware, but we were recently named the North American representative for them. The bottom line is they do have a reputation as being bad, specifically rare coin dealers, and I think it's probably well-deserved. We're trying to breathe a little fresh life into that market. ASI's bought and sold rare coins for 31 years now, but we did very, very little. I mean, it was a tiny percentage of our business because typically people were pushed into positions in rare coins in the past, and they weren't necessarily rare, they were old. There is a distinction. Just because something's really old doesn't make it rare. They produced a lot of them, and many survive. So what would happen is a rare coin dealer, very aggressive sales force, would go out there, call you at dinner time, or they'll hawk stuff late night on the cable channel saying this is the best thing since sliced bread, when the reality is it just happens to be the coin that's sitting in their display case at the time and they want to sell it for a profit. So our experience over the years was really helping people out of very bad positions in old coins that they never should have been in the first place to achieve their goals and objectives. That being the case, the reputation is out there that rare coin dealers are kind of like the used car salesman of the precious metals industry. That's deserved, like I said, but it doesn't need to be the norm going forward. So we think we're trying to push a new normal here, where if you look at truly rare coins or truly rare stamps. These are things at the high end of their respective genre. What you find is that they tend to be uncorrelated to any market, any typical type of economic situation, whether it be positive or negative. They're not tied or correlated to any investment. So they just plod along steadily. They actually increased in value during the 2007 to 2009 crisis, unlike virtually every other asset class on Earth, and they just kind of hold their own. And the reason they do that is because this market is not supported by investors, okay, or institutions or hedge funds. There's no hedge fund that's going to dump a huge portfolio of rare stamps or rare coins typically all of a sudden. This market is supported by collectors. Now, I'm not a collector. I have some rare stamps and rare coins, and the bottom line is I don't know what they are. I don't really care. They were handpicked by experts that we did 6 years worth of due diligence on, and I know they are material that will give me a reasonable chance at appreciation. I really don't care what they are, other than I know that they are the types of coins and stamps that the collectors covet. So I'm able to participate in that market as an investor in a small way and benefit from the fact that they hold on to things that they cherish. And that's a little bit different from virtually everything else out there right now. And in this volatile market, which I think is a watchword for the future. Get used to the volatility. It's not going away. I think rare stamps and rare coins actually provide a little bit of a buffer in this environment for a small percentage of your portfolio.
All right. And one other thing is, yes, you are the official North American representative of rare stamps. And I have to say, I was pretty, when I heard about it, I thought it was pretty cool. And I just want to can you give us a brief little rundown of their rare stamps program and a little bit about Stanley Gibbons?
Yeah, well, Stanley Gibbons is a 156-year-old London-based purveyor of stamps and collectibles, and we met them probably about 6-7 years ago, and did some due diligence from then until now to include buying ourselves to test the waters, if you will. We tend not to roll out anything to our clients or potential clients until we've done and experienced it ourselves. We want to make sure what we're saying is true and that we follow our own advice, take our own medicine. But Stanley Gibbons is really unique. They were started by Sir Stanley Gibbons, who basically started collecting shortly after he was born the year the first stamp in this world was printed, and that was in 1840, the penny black. And he found a way to buy and sell stamps for collectors. And the main part of their business is collecting. But there's a small portion that works with investors. Give you an idea, they take in probably about 2 to 3 million stamps a year through their offices. And out of those, I want to say 200 to 300 tops are potentials for investors where they have the ability to appreciate because they're unique, they're limited in number, errors versus just rare stamps that survived over time. So we work with a partner that basically knows the difference. I'll give you a quick side note to highlight their expertise. We were visiting there in London this past summer just to get a better feel for the team and to learn a bit more about rare stamps. And one of the experts in the Commonwealth section basically said, there is some issue with counterfeits. We see them from time to time. In fact, a few weeks ago, I had a stamp, a 100-year-old stamp. I was looking at it, and it was, the front looked fine, but it was clearly a counterfeit because the glue didn't smell right. I mean, these guys can smell a 100-year-old stamp and tell you that it's not right because the glue was altered. That's an expert in my book. And those are the folks that pick the stamps, and we do think it's something that everybody should consider for a small portion of their assets.
All right. Yeah, that sounds great. So, and if people want to find out more about you and want to do business with you, how can they do so?
Yeah, very simple. Thanks for asking. The name of the company, as you mentioned, is Asset Strategies International. We can be reached toll-free in the U.S. at 800-831-0007. And we could also be reached online on our website, ASSET, strategies, strategies.com. And finally, if you wanted to send an email as a result of this podcast, you can just send it to infoasi@assetstrategies.com.
All right. Thanks for coming on. I'd like to have you on with the future, and I just want to say personally, I used to work for these Rich and Michael. Of course, my other bosses, Steve and Carl, they operate with the highest integrity. I have the utmost respect for them. So, especially if you're looking for overseas diversification, this is a company you can trust.
Thanks, John.